Good afternoon, 3 p.m. sharp. We're here to talk about an important topic, tax considerations for divorcing business owners. So we're focusing on taxes, so don't go to your divorce lawyer for that. And we're focusing on divorcing couple fighting and wanting to split. We're focusing on business owners. So if you're a business owner, you're in the process of getting divorced, and you wonder what's going on with your taxes, you're in the right place. 30 minutes, we're going to cover important stuff that you really should know. Every business owner should know, really. Even if you're not divorcing, and what if you're preparing for that? You never know. Okay, let's get going. All right, you see our website. This is our website, communitycpa.com, and you can find information here. On the top where you see the lines with the multiple colors, the first one is onboarding with us. That is a button you can click, and you can register yourself and uploading your document. Even without being our client, you can just onboard yourself. Then we will know you are onboarded and we'll work with you. And of course, the second button there is appointment. You can make appointment with me or with our other partners when you got your time. Because you click, you will see our calendar, then you can book the time you want it. All right. We also have another website. It's really important too. It is a YouTube channel that we have. It's called Community CPA. If you come to this YouTube channel, not only you're going to see over 6,000 followers, you're also going to see over 2,000 videos. So those videos are the one we did from the past. Like every week, we produce 4 different videos, so you can choose from our content. For example, you're looking for divorcing and what you need to know. You just type into divorce, and then our webinars will pop up. Anything related to divorce will show up. So that is where you search our content instead of reading anything, and you can just hear us talking about it. Of course, this is the 2 books that I wrote from 2019 and 2023 is already on Amazon, and you can purchase from there. I always mention to folks that whatever money you paid for the book, I don't know what Amazon's price is, but whatever the price they're asking you to pay, and that money you send it to us, and it is all going to be donated to a nonprofit organization called the Immigrant Entrepreneurs Summit. It is a platform for 18 years long supporting immigrant business owners to grow in U.S., to learn U.S. rules and regulations, to be successful, and to make money. So it's a platform made for folks who are charged with energy and American dreams to make that come true. So not only we donate, there's other people, successful immigrant business owners, also coming to give money to IES so we can do our project, make our event happen and happen nicely. So I'm asking you to purchase our book, purchase my book, and so I donate to IES, or you can look up iesusa.org to donate to the IES there. IES is absolutely a sanctuary place for immigrant business owners. All right, no responsibility disclaimers, which just says that you need to take responsibility for the knowledge you learn on the internet that is free to you, but don't take it into your brain free. Really judging it, digest it before it becomes part of your knowledge hub, okay? All right, so divorcing as a business owner. So this is where the divorce obviously puts stress on you. And for business owners, I'll tell you this, the harder your business is running, the more likelihood you will get into stressful situation like that. And of course, you hear those well-doing people like Bill Gates, like Jeff Bezos, these people divorcing, right? They got too much money, so they divorce, and you don't really hear much about how they divide. But once small business owners, people like us, and we are trenched in everyday business work, then there you go. You have a spouse who are just not on the same pace with you, just making you feel like if I can just shake that off, then I may have a little better energy, or I may be able to do my business better. So I know these are all the consideration coming through, and with families and business and even political situation, God knows. So you are going through the stressful divorce. And your business ownership interest is often one of your largest personal asset, because that's all you do. You are trenched into operation. You didn't really spend any other time doing any other things. So business is the only thing you have. In many cases, part or all of it will be considered marital properties, which means that it's joint property. So even if you divorce your spouse and this person never really worked in your business at all, but it is still considered joint property. So understand the tax rules that apply to these asset division can help you avoid costly surprises. So this is where we're gonna focus on our today's understanding for you for in this process. So what we want to bring to you as a highlight, it is about this, what we call the tax-free transfer. Most assets can be divided between spouses, okay, without triggering federal income tax or gift tax. So I just want you to generally relate to that. As long as you're legally married. Of course, if you're not legally married, it really kind of depends on the state, whether it's a common law state or not. That part is more of a lawyer's work, right? But on tax side of things, we will tell you that, normally most of the asset can be divided without submitting something to IRS for taxes. Under the tax-free transfer rule, the spouse receiving the assets assumes is existing tax basis. So that language just means that, let's say you have a bicycle that is a marital asset. So when you get divorced, you're gonna cut the bicycle in half. One wheel goes to one person, the other wheel goes to the other person. The tax basis just means that what is the worth of that one wheel that you got? So let's say you bought the bicycle for $120. Day one, day two, you divorce, then $60 on each one of you. So that is the tax basis. Of course, tax basis, it is a very technical term. It involves a lot of more details in there because tax basis also has to reduce depreciations. If you ever familiar with those like monopoly money play, right? You bought something but you can depreciate the whole thing out, so the book value, the tax basis becomes zero, right? So this is the tax basis that is used to determine gain and loss in the event of sale. So you got that one wheel bicycle and you want to sell it to your cousin. One of the spouse gonna sell it to the cousin. So let's say that's $60. If you sell it for $70, you have a $10 capital gain, right? So that is what we're saying, that the transfer itself, you got one wheel, I got one wheel, that transfer itself is not taxable, but it's taxable after how you treat it. All right. So now let's continue to look at an example about the tax-free transfer. If you give your spouse marital home in exchange for keeping 100% of your business stock, that transfer is tax-free. So what does that mean? So let's say your home worth $200,000 and your company stock valued at $200,000. Both 400,000 belongs to both of you, right? But you're gonna swap. You're gonna say, no, don't do 50-50, and one spouse takes the home, the other spouse takes the company's stock. That it is a good example of tax-free transfer. Both the home and the stock remains as their original tax basis, the holding period for the new owner. Okay, so for example, I take the company stock in this split. So the company stock become mine. The tax basis say is 200,000. So now I'm going to hold my 200,000. If it is over a year, it's long-term capital gain. If I sell it for more than 200,000, then my extra, other than the basis, it would be taxed at the long-term capital gain rate. But if I sell that below a year, then I just got it now, I'm selling it right away, then you would have a short-term capital gain, if you have a gain. But what if you say that, well, I sell for less than the 200,000 tax basis I had, then you have a capital loss, right? So this is an example of what we mean by tax-free transfer. Tax-free transfer timing. Then you will say that, okay, fine, I understand the tax-free transfer, I can do this. But what is my timing? The tax-free transfer applies to the transfer made before, at the time, and after. So before the divorce is finalized, you can transfer. At the time you divorce, that you can do transfer. After divorce, if they occur within 1 year of the marriage ending, or within 6 years, if required under the divorce agreement. You see how the flexibility right now here is? So the free transfer could, in what cases they would have to say that, 1 year is not enough, I want 6 years, I want longer. So for example, it is possible that something in the business are in the making. The business is about to blow up. And the business is about to become a multi-million-dollar business or multi-billion-dollar business. Right now, it's just a little business. If you have that kind of thinking, then of course after divorce, the attorney will come in to make that agreement to say that the free transfer can happen at what time. So this is where the free transfer timing is something you can play with, right? Just depends on your situation. What about future tax consequences? So we got divorced, I got my share. What about the future consequences? While transfers may be free at the time you divorce, the recipient will owe taxes if the person later on sold the asset they got from the divorce. Okay? And the selling of it is going to go by fair market value. Then you may say that, well, how do you determine fair market value? I just gonna decide it while I'm drinking beers because that's the best way I evaluate my asset. No. The fair market value do have standards. So there's a valuation you can look into. You need to get valuation as well, especially going through divorce. You may think your business worth $1, but the person who wants to divorce may think your business worth $1 million. In that case, how can you divide? Because you don't even agree with what in front of you. Then the professional third-party business valuator would come in to help to decide what is that price, right? So if your ex-spouse receives 48% of your highly appreciated company stock, no tax was due at the time transfer. However, when your spouse sells the stock, that person will pay for all the capital gain that coming to this portion of asset. So highly appreciated stock just means that, your company, I know every time we talk about stock, you may be thinking about the stock that traded on the public platform like New York Stock Exchange. No. Every small companies, if you are a corporation, you have stock. If you are LLC, you have membership. So those are actually a unit price that you need to determine. So when you form the company, the attorney who did that work for you already issued stock. Maybe the person only issued 2 stocks, and so you have one, your spouse has one. That's possible. But a lot of times, like at Community CPA, when we work on formation of the company, and our attorney normally give 1,000 shares to incorporation, just incorporated entity, just because you could just you could just take 1 share, your spouse take 1 share, so leaving the 998 shares on the back to, just don't issue them, just leave them out there in case you got a new partner coming, you don't have to reissue stock. So there's technical reasons for how people do how many shares, but what it says is that once you become the shareholder of the company, if the company doing really well, then that just means that your share value appreciates. You don't need to watch stock market to know whether your share value appreciate or not. And you are just knowing your business. If your business makes more money every year, your stock is appreciating. You probably don't even know how much it's appreciating because nobody did that calculation for you. But you absolutely can ask your accountant to say that, what is my per share value at the end of the year? And they can calculate that for you based on what they see on your financials. Okay, so you do have the stock price all the time. You do know whether it's appreciated or depreciated, and it just depends on how well you run your business. The important notes on the taxes on assets, is that appreciated asset, appreciated stock comes with built-in tax liability. It just, anything appreciated is a built-in tax liability. And like you buy a property, and if you bought property for $10, 10 years later it's become a $100 property. So you have a built-in tax liability of $90. That's just how it is, right? That built-in liability makes them less valuable than the equal amount of cash and the non-appreciated property, right? So if you have appreciated asset on hand, you have potential possibilities ended up making tax payment to IRS because the value increased. But if you just have cash, of course, you divorce, you got $1 million cash in your pocket, they don't have a chance to appreciate. Cash is cash. Actually, with inflation, it goes down in value. So, what we want you to understand is that when you get divorced and you get these appreciable asset, back in your mind, you need to know that there's future tax consequences that would come to you. But if you come to Community CPA, we'll deal with the future. I always say that as long as you do tax planning every year and you take advantage of what's going on, right now in 2025, business people, if you plan your taxes properly, why would you even pay taxes in 2025? Didn't you know what about OBBBA, this stuff? Did you not know that? If you don't, just go on to our channel, type in OBBBA, and then study all of the stuff we're talking about. And of course, I say that you need to plan. You can't be like smoking your cigarette and drinking your beer and thinking your tax liability will go away now. And you need a plan. But for business people, I can't speak for the people who get earned income tax credit, child tax credit, those low-income folks. I'm not specialized in that area. But business people, folks, if you are a business owner, how could you look at 2025 goes, oh yeah, I'm going to pay a lot of taxes? You're crazy if you did that. But I congratulate you because our country really need a lot of taxes. There's just so many things need tax dollars. So if you made a contribution, be proud. I am not even going to tell you you shouldn't. Just go ahead, do it. And we need people like that. But if you're my client, I am frugal, so you better be frugal with me. So the rule also applies to ordinary income asset. So such as a business receivable, inventory stuff, those are ordinary income asset. When you get divorced with your spouse, and say that spouse has like $500,000 on account receivable, because it is account receivable, so there's no cash to give you, and you can have half of the account receivable. So whenever the account receivable receive the money, half of it goes to you. So that is your regular income asset. So you're gonna pay regular taxes on that one. So these can be, these rules can really change your outlook on cash flow. Okay? The recipients need to be aware of that and plan the taxes, negotiate that before you totally walk away from the negotiation table. So if I say this and make you feel like, well, yeah, you're right, and I need to do something about that, and so how come my attorney didn't tell me that this is income generating asset and I ended up paying more taxes? I mean, attorneys are all in very special areas. Some attorney are filing bankruptcy for people, some attorney are doing certain things for certain area, so they're not necessarily the tax attorney. So they may not even file their own taxes with you. So with themselves, they file that with their CPAs and stuff. So they may not come to realization. They only focus on today. They're looking at that, goes, oh yeah, there's no other asset, just receivable, and you get 250, and you got 250. But you are leaving the business because the business has no value. So the other spouse take the business. Now you got 250. Every time you get $1 out of that, maybe you could end up paying 37% of that to taxes. And I'm not even calculating state. I'm just saying you would end up with a lot of tax liabilities. So just be sure you negotiate that. Maybe your negotiation is to make sure that the taxes is paid by your ex, right? Valuation and adjustment for tax liability. This is really important as well. I mentioned a little bit about valuation. This is a critical step in the divorce, one involving business, because the business typically would become the focal point, then contentious point. People don't agree on the value, then it's hard to divide it in half. So in that case, you will have to evaluate your business. When evaluating a business interest for these purposes, the evaluator must understand what's appropriate under applicable state and the legal cases, state laws, the rules and regulations is not going to be the same from the state to state, right? Valuation process may also be very time consuming and contentious, especially if one spouse is actively involved in business, the other is not. So there's a lot of opinions on the valuation. So I have seen so many times, I won't even be able to count. When we come to a time where the business needs to be evaluated, the opinion is all over the place. If you hire 10 evaluators, you got 20 different values at a minimum. So that tells you, those valuations are subjective, at most. And even though everybody go by the rules, go by the understanding of their understanding, but everybody is capable of doing some sort of customized understanding. So valuation is not a 1 + 1 = 2. Valuation is 1 + 1 equals to whatever number, and that would be subjected to that evaluator, what they felt is most reasonable. So with that said, you can see that can be a messy divorce, right? If you don't even know the value of your business. Here I want to show you what are the key items that you need to consider when someone is doing valuation for you. So you want equipment, inventory, property to be looked at. You also want to look at the intellectual properties. Intellectual property sometimes is more like what you created. For example, if you have three restaurants, and they are all called the same name, so there is a public recognition of those names. So that has a goodwill and the intellectual property related to the name. So those are the things you want to evaluate as well. And other factors like how much money you owe to other people, right? And what about pending litigations? What about the market is tanking? It's like with the tariff, some company just completely went out of business. And we have company filing bankruptcy because of tariff. So that is how much of things people need to consider to evaluate. I know I don't need our business owners to evaluate, but of course you have strong opinion that need to be heard by your people, whoever evaluate your business. The key is to have an independent party to evaluate your business so the split can be fair. The tax liabilities evaluation is the thing that I want to mention to you because the deferred taxes on appreciated asset is consideration. Liability from unreported income is a consideration. Cash distributions and implications, from the goodwill, from the name recognition, or from the brand. Those are all tax liabilities once you've got the valuation number come out. These are significant consideration for any businesses when you are trying to split it. And that's when you're going to give a whole body scan and evaluate from the hairs all the way down to the toes. That's just how that should be. Not making it easy, right? I know that. I know what you are saying to me. It's never easy. If you ask my advice, I will just tell you that suck up and don't get divorced. Why do you have to get divorced? But, I know we don't control everyone, and I actually, even just before this webinar, I was dealing with a couple who owns a restaurant here in town, and they're fighting over a very ugly divorce. So they're trying to figure out the company worth and all of that stuff. So what I am talking about today is just happens, for real, in the real life. This is actually a request from one of our followers on YouTube channel and wanting us to talk about the divorce specifically for business owners. So what is so special? If you don't have a business, divorce can get really simple because your W-2 is yours. Your house, you can split. You sell the house, take half and half, right? And then, the kids, well, you can cut the kids in half, but you can split them with whoever take care of them on what day and that, and you can figure it out. But as soon as business is involved, and especially a upcoming good and a profitable business is involved, things can get ugly. So non-tax issues related to cash flow and liquidity. Cash flow and liquidity is not a tax related, but can impact the business and can be a very serious consequences if that is not dealt with properly. Because every time when you go through divorce, cash is what required because one spouse want to walk away. If you can just give me $500,000 today, I walk away. That is a demand of cash flow. That would really hindering your daily operation. So this is something, you want to be aware of. Sometimes I have seen people, I didn't do one for anyone, but I have seen people going back to the bank to finance the other half and to give to the spouse. So as a part of divorce settlement, and the bank is willing to carry the loan, believing in the business owner that this person can do it on his own. So those are the things we can as our CPA firm we can help to mitigate the cash flow and the liquidity issues of your company if you really do go through that. But a lot of it can be helped by negotiating with the ex to see whether that can come out slowly, right? Instead of $500,000, can we stretch that out to 5 years and with about $10,000 a month to pay out? Of course, your ex need to believe in you. But if you had such a bad relationship with your ex and they don't have any trust in you, then you don't have a choice but come up with the cash flow that's needed. The other thing is also exposing business and the privacy. This is not cash related, not tax related, but whatever you go through, that divorce proceeding may expose very sensitive business information. Something you don't talk about in the business, it is your trade secret. Now with divorce, it's going to come public. So the damage is definitely there. Obviously we would hope that every couple who are in business do not go through divorce because it only destroys the business a lot more than you can imagine. But of course, not every divorce resulted in shutting down the business. But a lot of times, the spouse also didn't realize how important the other spouse is for the business. And you think the other spouse just stay home and take care of kids and don't even step into your business, so this person has no contribution to your business? Absolutely wrong. Sometimes, do you believe in spirit? Do you believe in that universe and giving you certain things? I mean, if you just have that negative energy coming home, and you will never be able to run your business properly. So at home, and that's your sanctuary. That's where you go back home. You should relax and you should enjoy family and you should do other things and leaving your business at the business site, right? So if you can work in that way, and there is really no need for a divorce. But if you are coming to the point that you go home is actually take away from you, and that is where it would not be good for the business to stay together. So with that side, I always say that divorce is a personal decision, but it's also a very technical business decision. So is this divorce going to build your business or going to destroy your business? It is your call. But in my experience with our client, I would say that generally speaking, divorce will put your business backwards for many years. And even if you rebuild it, it would not be the same as what you had before. That's what we have seen in our clientele. All right. Plan ahead with community CPA to minimize your risk. I know if you get divorced, we don't help people to get divorced, but we help you to get your finances in order. So you want to plan that with us or with your tax preparer, with someone who understands the tax side of divorce. So to work with your attorney to get that in for you, right? So the financial matter is actually drives everything. Even if you got a smooth divorce, you kicked your spouse away, and you got your business with you, you didn't even hurt your cash flow, and you are a brand new person, and you can start working your business. And I would just say that it is a brand new. Everything is brand new. Because you are brand new and your business also is brand new, because the kind of support that you used to get, even if it is invisible support from your spouse, is no longer there. Or I say the kind of destruction that your ex-spouse gave you while you are running business is also not there. But not all the destruction is actually bad things to business. Some of our business owners are very quick at making decisions. Oh yes, I'm going to spend $500,000 to buy this. They don't think, they don't discuss. Only their spouse would come in and goes, is this really good? And can you do analysis for us to see how much money we'll make? Then if we buy this, how much taxes would we save? So your other body might just be a safety check for you, but to business people, it can be viewed as a roadblock. It's just somebody always trying to pick on me, and I'm not liking it. All of that, right? So maybe before you get divorced, go to a psychologist to really figure out what you are thinking, what was the causing. So for business owners, I still recommend don't get divorced. If you're already married, and try to stick together, because that is why you have the business. For good or bad, that business is a creation of the marriage. All right, takeaway for today. No matter how you want to split or divorce, always ask about tax consequences. And you might be working with attorneys who do not even file his own tax returns. So this is a good idea to bring a tax specialist with you and with you walking through this divorce journey. After all, there's only two things you must deal with, right, in life? Not divorce. Not everybody needs to deal with divorce. The two things you must deal with is death and taxes. Those are the two certain things. So whatever you do, bring a tax expert with you. It is highly recommended. I will talk to you more about why a tax expert is so important. So my last two slides, is related to selecting a partner to be on conference call with you. So you have all of us here, and you can go onto our website to click that appointment button, and you will see us. And the last slide, but not the least, this is where the final slides to give you our opening hours. We are a company open 6 days a week. Yes. All year long. We don't have tax season or not tax season. Every day is our tax season. So we open Monday to Saturday. If you call on Saturday, it's always a real person coming to the phone to answer your call. And we have, we have 2 shifts. So people work Monday to Friday or Tuesday to Saturday. Then you also have our website right here, and you have that email address that listed here. Catherine@communitycpa.com. If you have any special topics you want us to explore for you, you email her and we will put it on the webinar. After all, this is the channel where we want to give you our knowledge so you can do everything on your own, or you can decide on how to proceed with your needs from here. I will talk to you again on Saturday. Bye-bye.